So we are often told to put our money where our mouth is, to invest in the things we believe in, and we are all here talking about building democracy. And my guests here today believe we should keep that in mind as we're building our investment portfolios. Let me introduce Julie Kane. Julie is the CEO and co-founder of Democracy Investments. Also with me, Dr. Richard Rikoski, the chief economist and co-founder of Democracy Investments. Thank you both for being here. Julie, what is Democracy Investments? What's its mission?
Democracy Investments is an impact asset management firm focused on changing capital flows to defend and grow democracy. And our mission was born out of concern for the global trends in democracy that we've all been talking about today. 18 years of decline, the trends are not reversing, and there is a problem in the asset management industry. There are trillions of dollars tracking international indices that only look at market capitalization or the size of the company when deciding on inclusion of the security in the international index. This means trillions of retirement dollars are passively fueling the growth of authoritarian states. Our solution is to use democracy as a factor. So our international index is both market cap and democracy weighted. And we achieve this by our partnership with the Economist Democracy Index. The Economist magazine has been publishing country democracy scores for almost 20 years using 60 different indicators that roll up into these 5 themes. So this means our international index takes into account the strength of the electoral process. Is there a strong functioning of government? Is there protection of civil liberties? And is there strong political participation and political culture? And when we apply these country scores to the international index, it results in a very neutral and systematic process that overweights in democracy and underweights in authoritarianism. So our portfolio neutrally tilts towards countries like Japan, the UK, Switzerland, Taiwan, and Denmark. And we underweight China, the UAE, Saudi Arabia, Egypt. So our fund has 73% less China than your typical international index fund and 20% more in Denmark. This means that our portfolio is lowering the cost of capital for securities and democracies and helping those economies grow, and the reverse for authoritarianism. We leave every country in, so every security is held accountable to the most recent country democracy score. And when the fund gets really big, that means we can incentivize every country to improve their democracy score to get more capital. Now, the really good news is we launched just over 3 years ago, and since inception, the index that our product tracks has outperformed the MSCI and FTSE market cap international indices. And the products that track those, our product has outperformed significantly the other ETFs that track those indices. So democracy wins. Our investment thesis that democracy will outperform has been validated. We believe it will outperform over the long run. Now you can invest in democracy and make money.
Richard, the conventional wisdom is that China is the economic powerhouse, and that's where you should invest. You buck that trend. Explain.
3 reasons: economic growth, returns, and demographics. Suppose you have a company, and that company has a price, and it's got annual earnings. You get a price to earnings ratio. You manage that company based on that price to earnings ratio. If that company has a low price to earnings ratio, the smart thing to do is buy back your shares. Your company isn't expanding, but you're creating shareholder value. If instead that company has a high PE ratio, the smart thing to do is to issue shares and bring in money and grow the business. So you have this dichotomy. Low PE ratio means you're not growing, high PE ratio means you're growing. And if investors become enthusiastic about your company and you have a low PE ratio, they can bid up your stock price so that you have a high PE ratio and you become a growth stock. Apply this same logic to countries. If you have a country with a low PE ratio, fundamentally it's stagnant. But if you have a country with a high PE ratio, it's growing. We should want the democracies to have high PE ratios, and we should want the autocracies to have low PE ratios. But for the last 20 years, we've been pushing money into the autocracies and helping them build their economies. We should stop doing this. We should do the opposite. We should be investing in democracies. But this goes exactly to your question, which is, don't I have to invest in China to get good returns? Don't I have to invest in the BRICS, Brazil, Russia, India, China, and South Africa? So I think we should look at those returns and see what they actually look like. So what we have is a comparison, a 10-year comparison of the G7 and the BRICS, their returns. And this experiment was truncated. It was full 10 years, but it stopped when Russia invaded Ukraine and was delisted. So if you look at the bottom of the slide, you can see the GDP comparison in terms of growth of the BRICS versus G7. You get your confirmation bias. The BRICS expanded by 72%, while the G7 only grew by 22%. So the BRICS outgrew the G7. But look at the investment returns. The G7 crushed the BRICS. The best returning stock was the United States. That's a big portfolio. France and Japan were doing extremely well compared to China. India actually beat China. They're a tottering democracy. They probably should be on our team. China comes in about 6th, and they're not much better than Italy and Canada. So the moral of the story is that GDP growth does not guarantee investment returns. Corruption has a cost, and if you're just greedy, you should be investing in democracy. But the issue here that I think we also need to be aware of is we need to hurry up and think about reallocating what we're doing. Demographics are not on our side. Democracy is really easy when you're a small monoculture and everybody agrees on everything. Democracy is hard when you are a large, multi-ethnic, multicultural society. And as populations continue to expand, large democracies are disappearing. If you look at the top 10 countries by population, only the United States is left as a strong democracy. And we are being mauled by external forces trying to drive wedges between all of our populations so they fight and tear us apart. If you expand to the top 20 countries by population, Japan and Germany suddenly come into view. The two Axis powers, who we nation built with an emphasis on democracy. Nation building can work. And by the way, in the top 20 countries, there's another country we nation built, China, with an emphasis on them being a counterbalance to the Soviet Union. No emphasis on democracy, and knows how that worked out. So as you look at this and you see Germany falling out of the top 20, you see Japan receding in population relative to everyone else, you see we need an authoritarian containment policy for the 21st century. We need to nation build some more big democracies, but we also need to inhibit the per capita GDP growth of the authoritarians. And we can do that not by nations taking action, but by individual investors. Every single one of us, our portfolios are fueling the rise of authoritarians, as are pension investments, institutional investors, even sovereign wealth funds. So we all need to change our investment strategy and invest for the future of democracy.
Julie, how do we do it?
So our fund is an exchange-traded fund listed on the New York Stock Exchange with the ticker symbol DMCY. I'd like to thank you, Jean, for the great questions, and thank you, Anders and Jonas, and the important work of the Alliance of Democracies. Please check your portfolios and see where your international investments are allocated. Are you passively fueling the growth of authoritarian states? Democracy is outperformed. We think it will continue to outperform. Let's fund democracy and support defending democracy and the global fight for freedom. Thank you.
Julie Kane and Richard Rikoski of Democracy Investments. Thanks so much for joining us. Appreciate it.
Sarah Steen.